chart on your topic for today, planning and scanning, and I do believe for this week we have the document already uploaded. So let me double check if it came through correctly and accessible for everyone. Sometimes I'm just not sure just if it doesn't load by the click, then scroll down to the date. It's about a quarter of the way down, 12/8, and should open up for you, no problem. Take a look at a couple things. Last week I promised that today I would look at a few things such as, and let me double check here. Okay, so first and foremost, I got a question on why that the tweets that I'm sending out are confusing, and why do I send this out? It was kind of funny. It was, what you send is Greek to me, and I just wanted to reply back that this pilot program I started earlier this year was to see if it could help people get generate trade ideas and actionable trade ideas with good guidance, and give warning ahead of time, the setups before it happens. Most of these trades are all designed and worked out right here together in this room every single day. I just follow through with it, and then we've also started where we're going to try to increase our capacity to write and keep some of the trades, or most of the trades that we do, in the notes section, and then tweet that out. So for people that aren't here, you know, they can refer as members to the notes section. Another feature that we've done this year is that we've also implemented the Trade Navigator, the Ghost, not Ghost, but imaging, but what I put up on Trade Navigator, you could download to your own platform exactly how I've created it. So with that said, I know last week we made note that today we have a special planning and scanning session. I'm going to cover some interest rate effects of a strong dollar on specific markets and what seasonal trades to look for at Q1. And Q1 is so far out, most people say, why was he looking at the first quarter? Because when you think of first quarter, you think at the end of March, the end of the quarter. Everyone thinks of first quarter as March because that's the results that come in. I'm talking about the trades that we can implement at the beginning of the quarter into January that last going into February. Some of them we've already alluded to last week, which is the biotech potential peak as on or about January 9th. In fact, I note that my partner at PA Stock Alerts takes note of this and follows up with that for all the Money Show people. So our message does reach a lot of people. I just hope it's reaching you and it's actionable. A kind of thing that we like to do, and that's why I started this with those people with limited cash to make better trade decisions. And I just wanted to know if it was working, because some people are saying, I don't understand what he's talking about. You know, when we talk about the Russell should start to outperform, and you can sell as a spread. Well, I guess it would be hard to understand what this means if you don't know what the word spread or how to actionably initiate a spread trade. How much does it cost? What the margin requirements? Effectively, how do you put that trade on? We note that another tweet, we said copper prices bottom in December. And so today we're generating, and that was December 5th, that we put that out. In addition, we talked about in tribute to live cattle. This was a great little trade we did in looking for the seasonal decline in live cattle prices along with the loss of momentum. Ironically, it's celebrating it had celebrated its 50 years in existence. Many people didn't understand who's Clara Peller. I think you have to be a little bit older. It was an advertisement. She was very famous for Wendy's by yelling out, "Where's the beef?" Clara Peller was her name. Anyway, that made the beef market, I mean, that really was like the tagline to steak, even though it was a Wendy's commercial. It really accelerated a lot of popularity for beef, and beef consumption. At the time, you may recall that the agricultural markets were running advertisements like pork because we were going through an agricultural depression. Willie Nelson and gang were doing Farm Aid, so it was difficult in the 80s, and now that's kind of all changed. But anyway, we did take a nice trade and at least with guidance give you the exact trade what to do. We also did things such as give an observation and analysis on Apple and all of that, what to do, what strike prices, where we could see Apple get down to, like 112 by mid-December. I think that was a trade that didn't work out from a timing element because it didn't take till mid-December. It actually took the 1st of December, and so it worked out better than anyone expected. So we actually have had some very good short-term trades in Facebook, Twitter with, it looks, you know, when you see stocks up 5, 6, 8% overnight in a day, it's pretty, I think everyone in this room would understand, you know, that for short-term trades, you know, 7% move in a stock is a pretty decent, healthy return, especially if you're looking at stock replacement strategies, short-term duration, and that's the neat thing that what we want to strive to do is if a trade takes X amount of time, what's the right strategy? Again, last week we did a webinar where we said it's market condition that trumps and overrides option theories. Remember that? Option theorists would say, hey, implied volatility is very low. We need to do an option buying strategy. But sometimes you need to re-examine that by looking at what the condition of the market is and what the setup is. Okay, if you get a high closed doji and you know that after 2 bars you should see immediate result, you shouldn't be buying a leap. And if you're expecting a stock to move up, you can buy a short-term option and play the move, and that you know that after 2 time periods, if you don't see any response out of the trade, then as Malcolm, one of our students in the room, made mention, the LMORFN strategy, which was a joke. It was the old floor traders adage, let me out right fricking now, get out of the trade, exit the trade. And that's real simple. We're here to make money in the market. We have, for those that have limited capital, what's the best trade? You as a trader shouldn't really be afraid of trading any market, because the ones that you're more comfortable with are the ones that are probably the ones that'll get you in the most trouble anyway. Most people feel compelled to only want to trade the S&Ps and not the Russell, or most people don't want to learn, if you're trading a stock option, what's the difference between a stock option and a cattle option? All you're looking is direction for the trade, you're looking for working orders to get into the trade, and then you're looking at potential levels that the market could get to within a prescribed period of time to exit the trade, and then move on or re-examine the trade to see if maybe you should get back in on the trend. And that's really what it's about. So even here, looking at Apple, talking about, we did what's really neat and something that we take it a little step further is that you know that anytime I look at a trade, I'm not just looking at the front couple months. I'm looking at back months. I'll look at it like going out to the most active months all the way down to a year and a half out, maybe 2 years sometimes. And I wanted to see if there's any volume. And a lot of times we find our ideas are being similarly matched by all of a sudden surprise volume in a particular market's options. In fact, in Apple that day on November 25th, not that long ago, we talked about how Apple was hitting person's pivot resistance. We had loss of momentum, everything going for it to go down, and we suggested by looking at someone else had the very similar idea. And this is kind of spooky because I did hear some financial news over the weekend talking about fat finger and the velocity of the change and what happened with Apple, and they were rehashing it. And the funny thing is if everyone is long and on board that stock and a few people decide to get out heavily at first, it's going to be a cascading problem. And if there's electronic orders or stops in the market, they're going to get triggered. And guess what? You're going to see an avalanche of a very fast moving market condition. It doesn't mean that they'll stay at that level long enough for you to react to. In fact, the flash crash, many of you might not remember, but the flash crash, I had Johnny, my son, in the office, and I looked at my account and I said, oh my God, what am I up that I'm making so much money in? I couldn't get out of trades fast enough. And one of the trades I was in was, ironically, Apple. We were in puts. And so I couldn't click the button to get out fast enough. And that's why we use limit become market makers to get into a trade that and scale in maybe over time if it's a position trade, but use limit offers because if the market gets down there, you're acting to anticipating of a market move rather than reacting after the market's already moved. And as you all know, that getting out of a trade once it's hit the low and is bouncing all the way back up becomes very difficult, and unless you throw a market order, and we all know what happens when you throw market orders. It's better to just chase the market and place a limit bid above the asking price to get out. Many of you traders know what I'm referring to there. So anyway, the tweets have been somewhat instrumental, I think, in describing good trades. It's just that if people don't understand what this means, for example, check out volumes in 120 strikes in Jan, Dec, and February expiration. Look at, and also the 115 Dec puts smells like a retracement back to 112 soon. Well, soon was you know, I think by looking at the heavy inflow of volume when we take an option chain, and if you see like an option has 100,000 open interest, and then one day, one strike has 50,000 volume, you're seeing a 50% increase in the open interest in one strike one day. So looking at the volume as it compares to the open interest is very important, and it can kind of give you a guide whether or not it's initiating position or not. Open interest is very important. So I just wanted to start that with noting that. Now, this week was kind of like a little shortened thing. I really don't have much to say. I mean, the daily McClellan oscillator did break below the zero line, as we warned might happen last week. Crude oil is now down 33%. Last week it was down 31.5% or something like that. And I think the irony is that Friday's S&P 500 only generated 4 weekly buy signals and 24 weekly sell signals. Last week it was kind of like the same number of buys with 47 sell signals, and 27 of those 47 were energy stocks. So we are seeing, again, a little bit of weighting of money being taken off the table in certain areas. I still believe the XOP is, even though it's down almost 25% year to date, I think opportunities exist, and we'll be looking for that this week, today, tomorrow, and especially credit put spreads for stocks in that sector. And I don't know if I want to do the December. I think I want to go with the January for a starter, and maybe we'll look at some particular stocks if they have January weeklies, not rather than the monthly expiration. Also, looking at specialty retailer cores, it looks posed for a rally where the retail sector looks a little spotty. And something else we talked about is after Thanksgiving, that Black Friday, Cyber Monday, we typically do not see acceleration of price moves in some of the big department store names like Macy's and et cetera, and so far that theme seems to be working true. Amazon, a trade that we had scaled out, and this is a great argument for scaling out, because no matter how good you are as an analyst and your expectations for a market to get to a specific price, while trading options, time is not of a factor that's typically in your favor as a long directional trader. But scaling out makes a lot of sense in this particular market. Now, I am still in a small quarter last position. I have not gotten out of Amazon. Yes, in hindsight, it would have been great to get out at maybe $7 when we had an intraday high of those options at $7. The January expiration, I think that this will re-examine Amazon and maybe add to that trade a little bit, because we know where those options have been and we know where they're at. So actually, Amazon fell below its 50-day moving average last week, along with 85 other stocks in the S&P 500. And another thing is that Netflix is posed for a seasonal low. So I want to go over some of these bullet points and some of these trades. And again, buy copper on or about the 6th. We were supposed to have implemented that on Friday, and we'll take a look at that copper spread and what that means. Buy the nearby, sell the deferred. If it's a bull market, there's going to be demand more for the front month, and the front month should outpace the back month. So if you're not familiar with copper, that's not a problem. If you're not familiar with how to put on a spread, that's a problem. Basically, all you really need to do is open up. You can do with some platforms will allow you to put on a particular trade. And just let me see if I can get this up here that's easier for us. Okay, so by doing a spread, okay, so you take a dome, your depth of market, okay, and then what you do is you take, at the same time, you would look at, like, for example, one of the you go out in time and look at your volume on the market. So you could look at the March, June, you could look at the March, July, you can look at the March, May. Right now, the March and the May doesn't have a lot of time differential, and so the June contract's a little thin. We could also take a look at copper for the July contract, which is thinner, and the June contract is, whether it's June, you could probably do July. June doesn't move as much, so in a bull market, the spread, what you're looking to do is pretty, in essence, the only thing you're looking to do is reduce your capital inflow, right? Reduce your capital inflow of an outright position. As you can clearly see, the difference in pricing between March copper futures is 290.2 versus June, which is 289. So the front month is above the back month. To do a spread, you simply click on, when you believe that this is the time to enter and go long, you click on buy the front month and click sell the back the month, and now you're in a spread. So that's one way of doing it, is just open up two different domes with the same commodity, but the different months. Most people, the biggest problem they have is the error is in getting out of it. So basically, get long by hitting the offer of the contract you want to get long on, sell against the contract further out on a bull spread. You sell the bid, hit the bid by hitting the ask button on the bid, and then that way you would be long the March and short the June contract. Now we'll examine whether today is the day to get into this spread for succinct purposes, or maybe we can look to be a buyer on a little bit of a pullback. But this is a longer term trade. By doing a spread, it does reduce your capital requirements by margin requirements. If you're not familiar with this, without a doubt, contact your brokers and ask them what is the margin requirement in the spread relief, and see if that is something that you want to partake in. Because this particular trade, you're gonna be looking at buying that into and holding that at least by buying the March. We know we're going to have to get out of the March contract and roll out of that trade, but this is the strong seasonal tendency for that trade that starts on or about December 6th, and you exit by April 8th, because that's the strongest seasonal tendency for copper prices to go up. We have the cattle trade, a feeder, April feeder, live cattle trade. You buy the April cattle, you sell the April feeder cattle. And that's one that we would be entering in on or about today or tomorrow. Now, if we're bearish cattle, now why would we be buying it? Because we're bearish cattle and we're buying it, but we're more bearish. If cattle's going to go down, then the April, the feeder cattle might go down even more or outperform the live. And this is another way of trading a market and being directional, reducing your capital inflow, and you're still trading a like market, okay? Because it's the same market. It's copper, it's cattle, but this is feeder cattle. It's a like market. It's not like we're doing cattle hogs where, if cattle had bovine specific mad cow disease and hogs, everyone went to buy hogs, and if you were short hogs, cattle would go down. If you were long, it would be horrible. If the entire cattle complex goes down, it's generally the feeder cattle that will outperform to the downside or outperform the price move. It's more magnified. So I just wanted to go through some of those trades that are still in effect. The funny thing is, I had this week, as a reminder, going through the list, we had no high close doji buy signals. I had interesting only 3 top ADS, TH Horton, Mondelez as sell signals. So I want to take a kind of a look at that. Last week I had, in last week's sheet, we had 4 stocks, Facebook, and it was the only one that I had that was tagged as bullish. And then I had these three as bearish, and pretty much all three of those suffered downdrafts last week. So that the market directional weekly buy and sell signals, you know, we got to kind of take a look at review of that. As Bill McKee says, this sheet, I'm going to just remind everybody, this sheet is kind of like it's like a Greek restaurant. It's got something here for everybody. If you're a day trader, well, at least you can kind of get a trend of what to look at. If you're a position trader, there's something there for you. If you trade commodities, there's something there for you. If you just want to look at seeing what kind of opportunities are existing longer term, then you can obviously use this sheet. And then if you're just looking to see what's happening this week, real simple. We have our reports, events, and earnings, which are thin, to say the least. The biggest one, I think, for retail in earnings is going to be Costco. That's the one that I have. Adobe for as far as anything it's really relevant. RH is also kind of an interesting, and then Toll Brother, Hovanian. So we have Wednesday kind of like an indication of what's happening with people spending money either A, at Costco, or B, Toll Brothers. Now, as far as reports, Friday's unemployment report was probably one of the most muted market moves that I had seen. It had been one of the biggest hyped numbers. It was a big number in itself, and the market barely reacted, which was a little interesting in the sense that I don't think anyone baked 300,000 plus into the number. I think it may be a little unrealistic, and it might be discounted as holiday increase in part-time, as well as, you know, lower menial jobs rather than high-paying net worth jobs. With that said, I still think that we're going to have a little period of pause, choppiness, and that the Russell now is, if we are going to see continued growth, the opportunities would exist in the Russell. So that is like just a quick overall view of the weekly sheet here and some of the seasonal trades and the spread trades and how to do them and implement them. Stock sectors, nothing's really changed. The Dow transports are near quarterly resistance still. Biotech is still near quarterly resistance. The utilities are near quarterly resistance. And the financials, which finally got into the game last week, are now at quarterly resistance, which ends at the end of this month. This is the end of the quarter. So we have more and more stocks that I'm adding to this quarterly resistance. And as more stocks and sectors get to their quarterly resistance, it kind of leads me to believe that they're more prone and susceptible for profit-taking declines in the first quarter of next year. So I wouldn't be looking at January put options for some of the directional trade strategies. I would be looking at February or even going out as far as March, because if a trend takes 4 to 6 weeks to occur, then if you're only in an option that has 3 weeks of life left to it or 6 weeks of life left to it, and the trend takes 9 weeks, then you're going to shortchange yourself by not being able to participate in the majority of the trend. So those are the things that we're going to talk about, again, pretty much all week, but I wanted to highlight in today's planning and scanning session. Live cattle continues to melt down, and I think any going in true form and looking at some of these trades here, now that we're flat in the market and it's had more follow through the downside, what can we expect? An interesting aspect, this is open interest. And one of the tools that we do use is that's exclusive to commodities is the open interest level, net long or short positions held. And typically on a market rise, you would anticipate after a prolonged period of market upside action, you would see open interest continue to increase. But as we've seen over the summer since July, and again, July 3rd, something happened July 3rd. A lot of things, dynamics changed for the markets. Leadership changed July 3rd. Something happened on the 4th of July weekend, and it even shows in the market here, that we started to see prices accelerate to the upside, and we started to lose that net long open interest to the market. So with that said, it was just a matter of, hey, when is this thing going to see a liquidation? And from seasonal aspects, you know, we kind of use that as a guide to help us. The market was primed and ripe from a commitment of trader standpoint. It was primed and ripe from the open interest analysis, the momentum indicator of mine. Everything was primed and ready for cattle to look for a little seasonal decline. So the question now begs, at what point do we see support come in the market, and can we still play the downside? Yes, we can still play the downside. If we take a look at a weekly chart, we now are officially in a weekly sell signal. As you can see, the open interest has seen a massive decline, and until now, until the end of the year, we will see further weakness in the marketplace. What happens is that at New Year's, we see a lot of demand for people going out. So filet mignon, not the whole carcass, box beef. Filet mignon might be featured, surf and turf, that type of thing. But most people, maybe a prime rib. But for the most part, chuck and Heinz and other cuts of meat will be less of demand in the marketplace. And during the holidays, people also go back to turkeys, they go back to hams, bulk feast items, and so beef prices should still remain under pressure here. With that said, I think any rallies in the weekly market under the condition of anticipating the market staying within a bearish trend, we should see a continuation of lower highs, which means we should be able to see a pop to not just, if you see the moving average here, the moving average barely had a chance to break down. So from 169, which is the moving average levels, from 169 and near last week's opening range, which was 169.20. So in due spirit of a reactionary rally back, continuing a bear market trend or a negative or lower trend, then we should see resistance come in oops. I'm trying to, as you know what I'm trying to do, I'm trying to get this little box there to, there it is. All right. And I'm going to change that color over there without a doubt to a little bit of, I think, darker red than that. Yeah, that's pretty prevalent. So on a daily chart, we could take a look and say, well, gee, if John's looking maybe another day or two, you can see the daily moving averages are up here. We take a look at the weekly pivot point is, oh my gosh, it's also right up there using the weekly market action and the weekly highs, last week's open. This is certainly an area that if we did get kind of like the old false rally, the old short covering pump, then I would look for another wave to the downside in the market. We did get a nice continuation of lower prices met with follow through in decline in volume, so as well as open interest. So that's a nice healthy liquidation, and it shows that it can continue. So what that means is that if you do get a pop, that you can probably look to get right back in on those put options. All right. So, or maybe since we were buying the put options over here at near 171, what we would look to do is maybe drop the strike and go with 164. I think that it's very possible that we could see the market at minimum objective. If we get a rally first, I think minimum objective is we could see 160, and it's this black line horizontal area of support. So that's live cattle, and I wanted to continue with it because it is a seasonal trade and it does work going forward. Looking at the overall markets, I mean, they still look fairly healthy. You're in buy mode on a daily basis on all the markets here, on the major indices, but I think it's time for the Russell to start performing as well as it starts to look good from the volume perspective. So the actual on-balance volume indicator, if volume precedes price, then we should see a breakout to the upside. And the advanced decline is hovering closer to its high levels. So we're going to probably start and should start to see leadership coming in from the Russell. And if we do get any type of pullback in the market, it might be less pronounced in the Russell. Advances should be more pronounced in the Russell. In other words, I'm more bullish on the Russell based on the undertone conditions here, both volume and open interest. or volume in advanced decline. Looking at a stock play, BHP Billiton. You know, it's, as you can see, look at the daily ranges. It's like Swiss cheese. It's ... It's fairly thin. That's the problem. But if this stock does get a washout on light volume, and maybe down to, I'd like to, I don't know if we're going to see 46, but you know, I want to see at least this sector. I want to see SCCO, Southern SCCO is Southern Peru Copper. I want to see not one stock. I want to see a bunch of stocks starting to look, and SCCO looks a little healthier from a conditional change of higher lows. You know, that condition where the market is building, looks like it's building in a base. SCCO, as you can see, it is already in a weekly buy signal. It's had a weekly high close doji, and it's looking a little healthier as the volume also supports that move. So a good play, if things do turn around and people are going back to work and we're manufacturing and using things, buying cars, etc., moves over 31.71 is definitely an alert trade setup that we could look at, or you guys can program on your own. I'll be looking at SCCO as well. So what I can do is just put up a, where's my alert little button here? For time's sakes, we're going to add an alert. I'm going to put a quote board alert. Price alert, excuse me. I'm going to put a price alert, and I want to know if the price gets up to 31.75, pop-up message, play a sound, and hit OK. All right, so we do have an alert set up there. So if we get, and I know that's kind of like, well, why would you buy it, and why wouldn't you buy it here? Because, you know, we have an equal and opposite, and I want to buy if the market shows me that it's moving up, and buy on confirmation. Now we do not have, we have a daily PPS, but not a high close doji, and so maybe we want to watch for a high close doji for good confirmation. If the market is going to be bullish, my objective would be for this particular stock, it's in a seasonally strong period of time. Obviously, it's something that you can carry going into February or March or April, right? And if the market does take out that 31.75, aren't we making now confirmed higher high, higher low, a first generation higher high, higher low? What do I mean by first generation? It only has a higher low, all right? We have a higher high. So this is a first generation pattern. If it's going to, a second generation would be 3 highs, third generation 4 highs. That's just my little analogy. It's now just made a higher low. It had a higher high, but it didn't have, it finally made the higher high, and now we've got that trend before a downturn occurred, right? So this stock is demonstrating the next time it goes, it should see some accumulation. Stochastics is cycled down, so if this, it's at a pivot point. So this is another area that we could look at for, you know, something that's, I'm sure, under a lot of traders' radar screens right now. Who's looking at copper? They're all fixated on crude oil, which brings me to last but not least, crude oil. The interesting aspect, if we change this to a daily chart, I mean, from a seasonal perspective, it generally bottoms out like this week, right? It has a seasonal downturn, and so this is the time of the year where we see a bounce. Now, this is why I said XOP would be great credit put spreads, and so we're going to start to look for some stocks that might give us some opportunities as it probably just chops around and digests this huge move to the downside. On a weekly basis, crude oil did form a doji, which could indicate the bearish condition has waned. And so with the irony of the small speculators being long all the way down, and so were the hedge funds. That had to hurt. So needless to say, I think now's the time that we can start to look at the market from a perspective of at least a conditional change going from strong trend to consolidation, at least several weeks of choppiness. And this is a great trade to look for theta decay, because we've got the holidays ahead of us and we're going to collect some premium. So for this particular trade, note that the best seasonal time of the year is always the first week of February to get long. But needless to say, we do see after long-term declines, the market pops a little bit and it chops around, doesn't really go anywhere. So I'm looking for the market to just subside. I think implied volatility, because of the great decline in the market, will give us better option writing strategies. And again, it's the market condition that trumps potentially the option theorists. Looking at the market from a technical perspective, at least with volume analysis, at the point in time that we made those lows, you already can see where I'm drawing here. At the time we made we've taken out those prior lows in 2010. Note that the volume on the sell-off after how many, again, this is a weekly chart, so it's not like we just had 1 week of declines. We've been 1, 2, 3, 4, it's been multiple weeks. You'll note that from the point in time that we made this last major low, we have breached and have broken below that low substantially. I mean, that was around 70 bucks, and here we are at 64. Look where the volume analysis is. So to me, I think that this is, setting itself up for a pretty substantial basing action in here, and that's where I would say, pivots aren't probably going to be very effective for us because the market had too much of a washout to the downside. I mean, I've got monthly pivot now for December all the way here at 55, 65. I think that if we get closer to 62, last week's low, it'll give you a great opportunity for a credit put spread lasting into the January expiration, and we should see that little. So if in case I am wrong and the market has more to go down, I think the duration and being in the right strategy, you'll be able to survive that as far as a defined risk strategy. So when I look at the XOP, when I say, hey guys, the XOP has some significant opportunities here. We've gapped lower this morning, had a little bit of follow through on a weekly chart, and when we look at the volume analysis on XOP, it looks dramatically different than the volume analysis with the crude oil market. And so I think what the theory I can add there is that over time, I think there's been more, or maybe I could say there's probably been less participation back in the day in the XOP, less participation in this ETF back in 2009 in this time frame here that the market's been at. And then when I look at the volume levels, I go, well, you know what? I mean, if we were at that price and we're nearing that price, I mean, the volume levels are at about the same handle. From a seasonal perspective, it is very strong to note that there is some dynamic that keeps this market and puts in its annual low, not its seasonal, its annual low. The annual low would be February for crude oil. The annual low, as you can clearly see, is defined as this week on or about 12/10. So this might be a great week for us to look at a credit put spread in some of the stocks, or now we have to get a list of those names, in the S&P oil and gas exploration sector, the XOP. Okay? Well, that does kind of conclude today's session, and we went through a few stock trades that are going up on a seasonal event for the quarter, and every week we'll bring some. I think the cattle is still a vibrant market to play, especially through options. Just a dynamic money builder for folks with limited experience, and again, or an advanced trader with lots of experience. Doesn't matter to me. We should strive to look for and seek out those types of trades where if only we could trade once a month, and you had to pick out a trade that you could, potentially turn $600 and turn that around every month, and then, add to that position. I mean, every month you'd probably only have one trade. What would it be? These are the types of trade setups that I would look for as a seasonal perspective, markets that have adjoining or confirming technicals behind them that we can, are liquid enough to trade. So in any event, I do want to conclude with just showing you what the other indicator, the McClellan oscillator, based off of, again, is based off of the NYSE. So come on, baby. There we go. So looking at the looking on the weekly chart, you'll note that we are, how do you play this? Is this a zero-line reject? Well, we don't know that because the week's not over. But we did make a zero-line cross. And so the McClellan oscillator, this is kind of a strange event here in the sense that we went from oversold October 15th to overbought, and the market kept going higher. We had divergence, and the market kept going higher. And so now we have a zero-line cross. So anyone that's studied anything about the McClellan oscillator would know that a zero-line cross is not positive, yet the market continued to go up. So it is a wall of concern for the S&Ps, but remember the McClellan oscillator the data is based off the NYSE, New York Stock Exchange Composite Index. And it is as it says, I just highlighted over it so you can see that it's based off of moving averages and takes, of course, it's actually a 19 versus 39-day moving average. So with that said, when I take a look at the NYSE and I look at that McClellan oscillator and I look at the divergence between the outperformance of NASDAQ versus S&P 500, it's, a lot has to do with crude oil price structure decline. But I got news for you, folks. It's going to be an interesting January, especially when pension fund money brand new money comes into the market every year. This is going to be an exciting market for the first quarter, and we're going to have a whole shopping list of stocks. There's a ton of stocks that are near their 52-week lows or are negative on the year. The same culprits, JCPenney, Sears, and Herbalife. And so we've got those rebound stocks, the stocks that are outperformed the market in the sense that they've outperformed the market all year. They'll probably be the first stock to sell off as we get into January. Next, Amazon. I'm going to hold Amazon through the end of this week. And for the options, as we are still in a weekly buy, and if the market only comes back up to test that 325 handle, these are January 355. I'm not sticking around. I'm going to just lose too much theta, and I'm out of the trade, and we chalk it up as a just overall nice trade and a life lesson as to why it's important to scale out of trades. Because sometimes, no matter how good you are, the market doesn't get to where you need it to get to within a prescribed period of time. So with that said, that does conclude today's planning and scanning, and I hope I gave you some good insights, information to describe what the weekly sheet's about and how to use it for this week. Everyone, have a great trading week. For those that are going to be watching the recast recorder, I hope you got a nice insight on how simple it is to put on a spread trade. So let's get back to our regular